finish chapter 5 on evidence, and then do the multiple choice questions. And I think I'm going to hold off on setting out the exam because I think you guys have an exam due Friday. Is that correct?
Yeah.
Chapter 19.
Yeah.
So we'll hold off on it. And we might have to start the chapter 11. Now, the chapter 11 is not really chapter 11. I'll explain that later. But chapter 10 and chapter 11, this is a long story. Chapter 10 and 11 have most of the cash stuff. Chapter 10 also has some of the accounts receivable stuff. And so anyway, because they're doing this by cycles, the revenue cycle, it gets to be a little bit messy as far as when you're auditing an account, where it actually goes. But anyway, so long story short, we'll worry about that when we get to it. Okay, so let's go to I know I want to clean something up here a little bit. Let's go to page, or what is this, page 3? Yeah, where it says reliability. I didn't label this, and I should. Do me a favor and label this if you would. This is for documentary evidence. And now we bring that in shortly. Oops. So this comes down to documents. When there's documents, I did not make that clear when I went through this the first time. But the reliability here we're talking about is documentary evidence. And the question comes up, well, what about the auditor's direct personal knowledge? The auditor's direct personal knowledge. So if they do recalculation or reperformance, is more persuasive than documentary evidence. Something you do yourself, right, is more persuasive than something you get from somebody else. That's the whole idea behind it. So, so the auditor's direct personal knowledge is actually a better source, more persuasive than something that they get secondhand, either through another person or through documents. So if I do the calculations of whatever, depreciation expense, I do the calculations myself, I do the reperformance of the calculations or the recalculation of them, that is more persuasive than me getting documents from somebody about the depreciation expense. Okay, so this up here relates to documentary evidence, documents basically. Whereas this down here, the auditor's direct personal knowledge is the best. That's when you've done it, and it's not biased or anything like that. That it's the best knowledge is what you come up with yourself, not what you get from somebody else. Any questions on that? So yeah, so the auditor's direct, anytime you do recalculation, reperformance, that's usually the best evidence. Okay. I put this down here, obtained indirectly from inquiry. There's nothing wrong with documents. In fact, they rely on them quite a bit, but they're not as good as the direct personal knowledge. Okay. Did I talk about analytical procedures? I don't think I did. I'm gonna put something in here for analytical procedures just for kicks. These are usually ratios. And you're looking for plausible relationships. So they're usually ratios, it could be financial ratios, it could be non-financial stuff. It could be how many, does it make sense, the number of, for instance, the square footage of the store compared to the sales? There's a store that has 20,000 square feet that's doing business that should take 200,000 square feet or whatever it is. So you're also looking for plausible relationships between, it could be financial data or it could be non-financial, the square footage of a store. Those are things that you look for analytical procedures, and they generally aren't evidence of wrongdoing by themselves, but they make you want to look there. So if someone says that they have a hot dog stand and they're billing out, $3 million a year, it might be they got a really good hot dog stand, but it also might be that there's, fraud involved. So, you always look into those things. So the analytical procedures are, again, usually your ratios, quick ratio, all that kind of stuff. But it could be non-financial also, and you're looking for relationships that are plausible, that make sense, basically. If they don't make sense, okay. Audit documentation. Two words. The auditor's work papers. The auditor's work papers are there to do that every time, to support their opinion on the audit report. So it's their backup. It's when it's basically like evidence as if you're going into court, because that is likely what's going to happen if there is a problem. Especially if a company's doing poorly, company goes bankrupt. There's no use suing the company. They don't have any money. They're bankrupt. The only people that have any money left are the auditors. So a lot of times you get sued that way. But the auditor's work papers contain the evidence that they to back up their opinion. I think we talked about this before. The auditors own the work papers. So the auditors own the work papers. The client does not. And the client will not be allowed to look at the work papers either. Why? You don't want them to know what your level of materiality is, and there could be other things that are, maybe there's questionable people in management, that sort of thing. Those are all things that the client may say, well, I paid you all this money, I want to take a look at them. You can't let them do it, because if there's something specific that you told them to fix, then yeah. For instance, if you said this accounts receivable is overstated by $12,000, they may say, well, how'd you come up with that? And you can show them the documentation for that. But as far as the work papers themselves, no, those are owned by the auditors, and there's confidential information in there, and not just confidential information about the company, but it could be other people in the company that they have confidential information about that you don't want to get out. Okay. Planning, performance, and supervision of the audit. Planning the audit, kind of just what you think it is. You plan out what we're going to do, what you're going to test, you look for risks and all that kind of stuff. And that's all documented. So you're going to look and see what likely risks are for any given client, and they could be different for all different clients. All different clients have different problems. There is no two companies that are the same. Target is way different than Walmart. They're going to do things differently. They're going to have a different culture. They're going to have different documentations. They're going to have different, everything's going to be different. It's almost guaranteed. There are no two companies that are the same. So the risks are all going to be different. Performance of the audit is actually doing the audit, which is what you'd expect. Now, one of the strange things about auditing is that everything you do must be is reviewed. So anything that's significant to the audit is going to be reviewed, and quite honestly, anything that's significant to the audit will be in the work papers. And so all work in the work papers is basically reviewed. It might not all be reviewed by the people above, but somewhere along the line, it's going to get reviewed by somebody. By senior auditors. Manager, partners. And independent reviewers. We'll talk about in a moment. So when you do something, when you come in as an auditor, your work's going to be looked at by a number of people. There may be 5 or 6 people looking at your work. And that's not because they don't like you or don't trust you. That's just the way it is. It's a very, they're very nervous people. And so they want to know that other stuff is done right, because if things go wrong, they get dragged into court. It's bad. So, but all work is reviewed by senior auditors, managers, partners, and independent reviewers can all review your work. So, and I think I mentioned before that all the work has to be done, has to be repeatable with the same results, not the same judgment, but the same results. Okay. All right, support for the audit. Oh, I already got that up here. The work paper support the opinion. Okay, working paper review. I'm going to change. I'm going to put the maybe a better term, a more recent terminology out here. This is the more current for that, and I should update this. Audit engagement quality control review. I should put review on here. Oops. Give you an extra E. See, give you extra for your money. I pay your tuition, I give you an extra E right there in the quality control review. All right, so it's the same thing. But so you're done with the audit, and everybody in the engagement team has signed off on it. Right. Okay. Oftentimes for private practice, they are they will have someone come in who is not on the audit. It could be a senior partner. It could be somebody else who's not, not closely working on the audit. But they'll have somebody come in and look at the audit. So you'll have an expert, someone who knows about auditing will come in and look at the audit. Now, for the AICPA, quality control review be performed quality review can be performed after the audit is issued. So you can issue the audit report and then after somebody can look at it. If they find any discrepancies or things that they should, additional work they think you should do, the auditors can go back and do that work and see if it changes the audit report, and they may have to reissue the audit report, depending if there's anything in it. But so if there is something missing, the auditors can go back in and do the procedures that they need to do to satisfy the reviewer, whoever the reviewer is. Now, remember, the AICPA rules, a lot of those are aimed at non-issuers. So these non-issuers, a lot of times are smaller places. There's probably fewer number of people that are relying on it. If I have a hot dog stand and I get an audit, there's probably not that many people. Maybe the bank is relying on it. So if there's something that needs to be done, you go back and figure. If it's a publicly traded company, you do not want an error to go out because there could be millions of people relying on it immediately. So, as you can probably guess, must be performed before before? Yeah. So AICPA, it can be done after. If there's a problem, you go and you can correct it. Or you might just get the evidence and it might not be anything. But you must go there. And if there is a problem, you can reissue the report. PCAOB says, no. You have to have this review done, and it has to be done before this audit report goes out. So it's reviewed by somebody independent of the audit before it goes out. And if there's anything that they think that you need to do, you need to go back in and do it. You need to test for this or that or whatever it is. So and by the way, this is really this quality control stuff for the both the AICPA and the PCAOB is really big stuff now. This is stuff they test you on. So AICPA, you can do it after. PCAOB, you must have it done before the audit report goes out. Okay. I don't know how important this stuff is to memorize. There's a permanent file and a current year audit file. The permanent file is something that you pull out every year. When you go do an audit, if you've done it before, they will pull out, okay, this is the permanent file from the year before, and it's stuff that you'll need to use this year. You may need to update it, you know, but it's a starting point, so you're not starting from zero. And you'll pull it out, and it'll have a number of different things that you would expect to see in there. For instance, the chart of accounts. That probably doesn't change too much from year to year. Organization chart, you may have to update that. Okay, you know, Sarah is now the vice president of whatever, and you know, Charlie is now whatever, you know, that kind of stuff. But you're going to have some starting point, and that's what this permanent file is. It's a starting point. The current year one is just what it says, only for the current year. You know, so a lot of the stuff that you know in the permanent file, are you going to have the, you know, the income stuff from the previous year? No, because they're going to have income stuff from this year. That's what you're going to audit. So a lot of the stuff is not going to be carried over. Now, to be quite honest with you, there is no, you know, there is no must have this, cannot have that. You can put in the permanent file whatever you want. That's the reality of it. So these are the normal things you'd see in there. However, there are no rules that say, oh, you can't have the audit plan from the previous year in there. You know, you can. There's nothing wrong with it. You know, these are just more of the common things that you'll see in there. Okay. Ownership of the documentation, kind of already talked about that. This is auditors only documentation. However, the client's information is confidential. However, client information is confidential. And I think I talked about this before. You do not release this information unless you get a valid subpoena. I think it's somewhere up in this thing. I think we had it. Okay, audit documentation archiving, I should say. I must retain the work papers for AICPA, 5 years. PCAOB, 7 years. I'll look it up before I write it down here. I think there are some government agencies that require 10 years, but the AICPA and the PCAOB are 5 and 7. So you have to keep the work papers around for that many years. And what happens is, just so you know, they usually, after that period of time, they'll get rid of them. That's it could be a liability. Okay, changes to audit documentation after the audit. Audit work papers usually need to be cleaned up after the audit. There will be a lot of things in the work papers, things that you looked into. For example, let's say that you got a tip from somebody that the payroll clerk was embezzling money from the company. Okay, so you get this tip. Okay, the payroll clerk is embezzling money from the company. And you look into it, and it's just complete nonsense. There's nothing to it at all, right? But you get this tip or whatever. Now, you may have done some investigation, to see what it is and all that. Now, you don't really want that hanging around your work papers. This is stuff accusing somebody of something they didn't do. This is, slander, or libel, but for whoever that person is. So it's not unusual for stuff like that. If you look into it, there's nothing to it. I actually had something like this happen one time in an audit. Someone, a friend, oh, I gotta tell you something, and it was ridiculous. So anyway, when this happens, you can clean up the work and say, okay, get rid of this. We don't need it. It was, it was nothing to the audit. It had nothing to do with the audit. So get rid of it. There's no reason to have it in there. So a lot of cleaning up will go on in the work papers. It could be, maybe a test was botched or something, and you had to redo the test completely, and you didn't rely on the first test, because of whatever, they used the wrong files or whatever. There's no reason to have those around. They had nothing to do. They had no bearing on the audit. Even though you have the documentation for it of doing it incorrectly, there's no reason to have it there. So you go through and they clean it up. Okay, now the question is, how long can you do this? Can you go? Can you go out a year or 2 years? No. AICPA says you have to clean this up in 60 days. PCAOB, 45 days. After 45 days or 60 days for the PCAOB. Okay, so once this time frame has gone, this is for both of them, you can no longer take things out of the work papers. So 60 days for the AICPA, if it's a public trade company, 45 days. You can add things to the file, you cannot take them away. So nothing can be taken out of the file after 60 days for the AICPA and 45 days for the PCAOB. You can always add things to the file. So, you're auditing IBM and, throughout the year, IBM does stuff. You can add stuff to the file so that you know about it when you go to the audit. For instance, IBM buys up some competitor or whatever. You probably make a note of that and put it in the file. You're not going to take anything out of the file. Right. So you can always add to the file for how, whatever you want to do with that for any time, length of time throughout the year. But you cannot take anything out after the 60 days or 45 days. Question on that thing? And so, yeah, so you have to clean up the audit. So anything you're going to take out, you have a limited time that you can do that. And the reason being is obviously they want this to be a good documentation set of evidence, so that if something is wrong or something needs to be investigated, that the information will be there. Someone doesn't start destroying the evidence or whatever after that period of time. Okay. Analytical procedures, we talked about this, I think, up here somewhere. We probably should move that one. Yeah. Okay, analytical procedures. Analytical procedures are things that, you look for plausible relationships. You actually look for things that might cause you concern that you may want to look into further. And they generally focus on audit risks. So plausible relationships, and they focus on audit risks. And so here is an example of 2019. Had sales of 260,000 and advertising expense of 31,000. In year 2020, they had 280 in advertising expense of 22,000. What is unusual about this? What's unusual about this data?
The revenue doesn't go with the expenses. You realize that in 2020, the revenue was 180,000, but the advertising expenses was 22.
Yeah, exactly.
And yeah.
Yeah, you'd expect the advertising has some impact on the revenue, whether you pay more commissions or you do more advertising to make more sales or whatever it is. You would think that there's a plausible relationship. You think that the more advertising, the more revenues you have, probably the more advertising. That would be that they probably go up together. But this is just the opposite. Now, is this proof of fraud?
I would say so.
It's actually not proof. You're gonna have to investigate it because and that's what that's what analytical procedures do. They don't actually usually catch the fraud, but they tell you where to look. So analytical procedures tell you where to look for fraud. I should say misstatements. It's possible it's due to anyway, where to look for misstatements. Again, they're usually not proof in of themselves. There's a get into a can of worms here. It is possible that you use them for that as a substantive testing, but for the most part, they're just used to say, okay, this is unusual, this is weird. Why don't you go look at that? Either the advertising expense is too low here, check into that, or maybe these revenues are too high, right? Especially if you're paying commissions, you'd expect that the more sales would have more commissions paid, and so you may look into it. So they actually don't usually tell you if it actually is fraud. It just could be that whatever it is, their advertising is more effective and they have less of it and they're making more sales. It could be just a quality improvement, thing. But you don't know that, and the analytical procedures will kind of show you, okay, look at this area here. Now, once you do the analytical procedures, then you start planning on how are we going to test it. So you say, okay, Well, we gotta test these advertising expenses because it doesn't look right. There's a risk here. That either the expenses are too low or the sales are too high. That's kind of risk. So you probably start designing tests around those two scenarios, saying, okay, well, let's see if, if either one of those is, how do we test those things? How do we test those? So once you do these analytical procedures, coming down here, then you start doing these, setting up your test of controls, which are you going to rely on the controls? So this would be, oops. Hey. And that's really for both of these. The analytical procedures will indicate what you need to test. You might do it through testing the controls and do substantive testing. Depending on what it is, you might do just substantive testing. But these test of controls, which we talked about before, that was we said old we said old test on it. Especially this one down here, substantive testing, all the classical sampling, mean per unit, all that kind of stuff. Probably monetary unit sampling, all that. Analytical procedures are the ones that kind of tell you where to look for those things. And and by the way, you are required to do this. Analytical procedures are required. And they're required because something like 95, I've seen it even up to from 90 to 100%, or 98% or whatever of fraud is found this way. Let's say 90 just to be safe. So something like 90% of financial fraud is identified through analytical procedures. It's such a huge margin that it's required. You have to do analytical procedures. You'll actually do them at the end of the audit also, because at the end of the audit, once the company makes all the changes you suggest and all that kind of stuff, you want to see if the financial statement still makes sense. Maybe I'll give an example of that later. But so you do these analytical procedures at the beginning of the audit, you do them at the end of the audit. At the end of the audit, you're looking to say, okay, we're comfortable with the financial statements, but do they make sense? We're going to run these same analytical procedures and see if anything pops out that we didn't recognize before. But again, they are not evidence of themselves by themselves usually, but they usually say, okay, look here for the bad stuff. And by the way, auditors will oftentimes catch financial statement fraud on the financial statements. They rarely catch individual fraud. Usually somebody in the company catches that. So, I think I talked about this before. As auditors, we don't look for all fraud. Most fraud is caught by people inside the company. If it's, somebody's stealing something, embezzling something, whatever it is, that's usually caught within the company. But financial statement fraud is oftentimes caught by the auditors. And it's much, it's much less rare. And I think I talked about this before too. we don't really generally look at individuals too much because they take a large company. You take something like Walmart, you know, somebody could be stealing $50 million a year from Walmart and it's not material. You wouldn't be looking for it. Just, you know, you only look for things that are material, and a lot of times fraud by individuals is not. So even though we catch fraud, you know, using the analytical procedures on the financial statements, that this does not usually catch somebody individual doing something in the company unless they're really doing something crazy large. It just doesn't pick it up usually. Is that it for Handout? Hey. Oh, okay. Well, I think what I'm going to do now is I'm going to send out the multiple choice. Give me a second here. Make sure I don't send out the wrong thing. Sure, the right class. Okay. Okay, I sent you the emails with them, and it's available in the handouts, class handouts. And we'll go ahead and start a poll, I guess. So I tell you what, yeah, you can work on it, and we'll take a break at the same time. You know, so if you're done with it, you want to take a break, feel free. I'm going to check really quickly just to see if it has not come through yet. Oh, there we go. Okay. Is anyone still working on this, on the multiple choice questions? We're still working on it. Okay. Okay, looks like everybody is in. All right, let me end the poll. Shared results. Okay. Number one, a confirmation is used to, yes, verify a representation for a third party. Yeah, so you think about it as like the bank confirmation. You know, it's a third party, and they're making the representation that this is what is in the account, this is what the loans are, this is blah blah blah. So yeah, that's what a confirmation was. Which of is only, let's say, auditor's judgment. Most important one there, and everything is judgment. And quite honestly, if you look at all of these, you know, by the way, all this stuff goes into it, right? But if you look at those are all judgment calls, right? The materiality, what's material? Is $5 million material, or is it $8 million, whatever it is? So judgment goes into all of these. What's the risk? You know, risks are judgment calls. And reasonable assurance, how much do you need to, how much evidence do you need to get? What's reasonable? Is it 90%, 95%, 99%, whatever it is? What is a reasonable assurance? So everything that you do in auditing comes down to judgment, which is why it's so difficult to have the consistency, you know, that of all the audits. You know, so you say, well, why, you know, if once a bad audit's done, why can't, how do we avoid this? How can it never happen? Well, it's judgment. It's difficult to control that way. During the translation recorded, the direction tests you go from. Yes, so you're wondering if they are complete. So you get the original source document. So if you have a shipping document, you say, okay, there's something that shipped here. We got to make sure that that ends up on as a sale. It's taken out of inventory and all that kind of stuff. So yeah, the original source documents. And you can't go the other way. If you go from the recorded stuff that's already recorded, that doesn't, you might find all the documents, but it doesn't mean that there aren't documents that aren't matched up, with the recorded amounts. Okay. Just for unsupported ledger entry, unsupported entries in the ledger, I should say. The direction should start from the ledger entries. So unsupported ledger entries, you say, okay, I don't know if this sale is really true. So then I want to see the shipping documents on it. You'll go through and see if there actually were shipping documents on it. Excuse me. Which the following is the least reliable type of audit evidence. You got to kind of go through all of them because you're looking for which is the least. Auditor and third-party vendors. So these are third parties, outsiders, third-party people. This is the best evidence. And so you guys are correct. Why? It's asking the controller about an end of the period adjustment. Not that it's a waste of time to talk to the controller, but you're probably going to have to get other evidence on that rather than just taking them at their word for it. So it isn't that, like I say, that would be more like something that would aim you in the direction to see if you can figure out what's going on. But yeah, the worst evidence is coming from somebody else, and it's inside the company. So somebody inside the company. And again, it's not yourself doing it, it's coming from somebody else. Outsiders, third parties are considered more reliable because they're generally considered not to have an interest in it, right? So, yeah, this is audit documentation prepared by, we just talked about this. They're the property of the auditors. And you do not share those. I don't know if they're required to by law, but need a subpoena. Okay. Yeah, stuff on consignment. Consignment is, it can happen in a number of different ways. The most one that people think about is if you want to sell a car, sometimes you take it to one of these auto lots and they'll let you put your car out there on consignment. They'll say, okay, you can put it on our lot and we'll sell the car, and when we sell it, we'll take 20% of whatever the sale is, or that's a consignment. Now the auto lot doesn't own the car. Whoever, you own the car until it's sold and then somebody else owns it, but the auto lot never takes possession of it. So the problem can happen though. You can have this inventory mixed in with the client's inventory. And you might say, well, okay, well, who cares? So what if it ends up, so what if some of this inventory ends up in the client, the client counts this inventory that they really don't own? What's the problem with that? And this is the problem of it. That the ending inventory goes into the calculation for the cost of goods sold. And by the way, this is not just for this problem, this is for other problems too. So if you're wondering why they get so crazy about the ending inventories, it's because of this. So, notice what could happen. Let's say that your ending inventory, instead of being 120, they include some of this inventory from somebody else. You run into this scenario where you have because this extra inventory is put in there, it makes your profits look a lot more because it it means your cost of goods sold is less. So there is a problem with it, you know, that you want to make sure that they have the actual title to it. And you guys hit it on the head. What am I doing these anyways? Rights and obligations. So you want to try to avoid having them count that inventory that isn't theirs because it'll increase their profits. It'll fraudulently or whatever increase their profit. Okay. Well, everyone picked A, and A is correct. So I guess I don't need to talk about that one. Yeah, just because something is expensive doesn't mean you don't have to test it. You may not want to test it, but you know, just because it's expensive to do, it's not a valid reason to reduce the testing, whereas all the rest of these are. If you think the control risk is low, in other words, the controls are really good, you can reduce the testing. Low inherent risk would be that, for instance, like petty cash. You know, how much could it be off by, right? I mean, it's petty cash, there's a couple $100 in there or something. So, you know, the low inherent risk might say, okay, well, we're not going to test that because, you know, even if the whole thing is messed up, it doesn't really matter too much. And high quality of evidence gathered. If you get really good evidence, it's possible you can get less of it. You have to get sufficient, appropriate evidence, but you know, sufficient just means get enough good evidence, and if the evidence is better, then yeah, hang on to space here. Number 10. 10 I liked because there's actually a couple of different things. Rights and obligation is probably the best answer. But there's other ones. If someone picked existence and or occurrence, it is possible that those, and the completeness one is also one that is actually can be looked at through this. The reason being, these lease agreements sometimes the lease agreements are such that they have to be capitalized, that you should have them on the books as assets. They may have them on the books not as assets and say, okay, you know, we're just leasing these. But if it's what's called a capital lease, that is when you know that you actually put it on the books as if you own it. That you know that's the appropriate accounting for it. You know, it could very well be that these leases should be carried on the books as assets. So it could also be a completeness thing, that they don't have all the assets on the books because they're saying that these are leased, but because it's what they call a capital lease, it could also be on there. I had an audit where we had that. I think I don't know if I told you guys this, and I had a boring auditor story, but there was oh, by the way, you guys got them all right, so you guys get all the points. I always did inventory. I was inventory guy for whatever reason. And so I was always doing inventory, and we would do this one audit, and they said, and then the lead auditor had worked on inventory, I think 3 or 4 years earlier, and there was a bunch of audit points that he wanted to clear up. So he said, I'm going to take inventory. So he gave me fixed assets, which is, you know, the big machines and all that kind of stuff, which I'm like, great, you know, this is going to be so easy because, you know, inventory is a real pain. Stuff comes in and goes out every day, and you know it's related to purchasing and accounts payable and selling and accounts receivable, and there's all the, you know, and it just, you know, it's a moving target. You know, because up to from the first day of the year to the last day of the year, you're trying to figure out what goes in where. And, you know, and then there's a lot of it. And, you know, and it's not just that, it's that there is all these different costs involved in it too. So it's not just counting the inventory, it's also, there's a cost factor. And actually, after we do this, the one on accounts receivable, we're gonna do inventory. The inventory account. But anyway, so I was like, okay, this is great. You know, fixed assets, but you know, they have a big machine, they get like 3 of them a year. You go, you look, okay, there's a big machine. You know, so I thought, okay, this would be great. You know, well, they had all these leased assets, and they all were, not all of them were, but many of them were what they call capital leases. They should have been put on the books. And these have been around for a number of years. So I had to go through and recalculate, you know, what would it take to take off all the expenses for the leases, capitalize the lease, what was owned, what was the liability, put these things on the books. It was a nightmare. It was like unmixing a cake. You know, it was just, but anyway, you know, here I am thinking that this is going to be the, you know, oh, wow, you know, this is great. I'll be, you know, the easiest audit I've ever had. But because of leases, it ended up being really, really bad. It wasn't that bad, but okay, I'm going to save this. What do I do here? 1 second. Okay. All right. Well, yeah, we'll get started on the next one. I'll send it out. So this is going to show up as a chapter 11 handout. It really is another chapter 10 handout, but just to make it easier to deal with. Oops. Okay, and it is also available in Blackboard. I don't know why Blackboard is taking so long to email stuff. Do it again. You know what? I'm gonna pretend like I'm a human. I'm not gonna, well, let's just stop right here. Because this will be, I still gotta send stuff out for the chapter 5, the chapter 5 exam, because you already got an exam to turn in this week. So this will be a third topic on top of it. We're gonna call it a night. We'll call it a night right now. We'll do the handout. We'll do the chapter 11 handout next week. All right. What are we doing here? Yeah. So anyway, so we will. This will be it. So we don't get three topics in the air at the same time. So now I know that some of you have already turned in the chapter 19. But those of you that have not, obviously. Yeah, so we'll call it a night. The only thing you got to turn in chapter 19, if you already have, then enjoy your week. Any questions?
If you say chapter 19, do you mean the handout or the test?
The test.
Okay.
Well, yeah, I mean, there should be a place for both of them. Did I put that in there? I don't know if I did or not. Let me check to make sure that I. Yeah, they hand out an examiner there to turn in. And you had, I don't know when the date, I should look at the due date on it. They should be the same due date, I would think. November 12th. Yeah, this Friday.
Good night, Professor.
All right, have a good evening. I will see you guys in a week's time.
Good night.
Good night. Yes. And you guys can turn in even if it's late, you can turn it in. There's no penalty for turning it in late.
Right, but I'm just trying to play catch up right now, so I have like so much to go through.
Yeah. Well, yeah, and you can see that in whatever the
Yeah, I mean, the exam that I was doing Friday, I have it pretty much done. I did it on Excel. I'm just copying everything on the actual exam and then just answer a few questions. Should be done pretty much tonight.
Okay.
But then I'll send you over whatever is due Friday to work on that too.
Okay. Yeah. And again, you get full credit for it and all that. It just won't be in your grade until I.
No, I know.
Yeah.
I know. Thank you.
Right.